All right, welcome back to Bloomberg News. I'm Matt Miller, standing in for Lori Rothman today. Stocks continue to fluctuate today, although the banks aren't doing terribly. All three major indexes are down marginally, though, year to date. Harry Rady is CEO of Rady Asset Management. He manages the Rady Contrarian Long Short Fund and the long-only Rady Opportunistic Value Fund, which is ranked in the top 1% by PSN Informa for its performance through June. He says the market is vulnerable right now, and he joins us from San Diego with more on that. Harry, thanks for taking some time out of your day for us today. We appreciate it. Let me ask you about where the market's most vulnerable, because I talked to you earlier. You think we're going to move kind of sideways here, trade in a range. What are the problem areas?
Yeah, I think it's really a tale of two markets. It's difficult to generalize, when you're talking about thousands of stocks. There's always overvalued stocks and undervalued stocks. And when I say it's a tale of two markets, I mean that there's been this sort of a beta rally or low-quality junk stocks that, in many cases have rallied 100, 200, 300%. So we see opportunity on the short side in shorting these low-quality junk stocks. And then these high-quality, blue-chip, dominant companies, for whatever reason, have been left for dead. So we see an opportunity to buy some very high-quality, blue-chip companies trading near their lows. And in addition, we see the market trading sideways for the rest of the year, and that really lends itself to a long-short manager like us.
I was going to point out, you hear from traders all the time that when the market trades in a range, that's when the smart money really makes its gains. And you say, really, as a long-short fund manager, you're really positioned best to take advantage of this kind of market.
Absolutely. A long-short value manager really shines when it really comes down to bottom-up stock picking, and the momentum traders kind of fall by the wayside. And so we're bottom-up stock pickers, buying these high-quality, dominant companies, and we buy sectors and companies when they're out of favor. And if you'd like, I could give you a few examples.
Yeah, let's talk about some of the opportunities in the market right now. What do you think has been undervalued?
One thing that your viewers might find interesting is we're long the TBT, which is basically short, long-dated U.S. Treasuries. As we all know, the U.S. government has been issuing debt, hand over fist. And so, yet long rates are trading at historical lows. Well, even if inflation doesn't tick up, we think the government's reliance on foreign buyers to finance our balance sheet is dangerous, and that at some point they're going to demand a higher risk premium in the form of higher rates. And so we're very bullish on the TBT, which means we're very bearish on long-dated treasuries.
What do you think about equity sectors here? Are you looking at dividend-paying stocks, which have been getting a lot more attention but really haven't been getting the upside?
Yeah, when you buy the types of stocks that we do, which are these large-cap, blue-chip companies, that by default, they're typically dividend-paying companies. And the sectors that we see as out of favor, having declined precipitously, trading near their lows, are sectors like the utility stocks, many of the healthcare, specifically drug and biotech stocks, the video gaming stocks, and last but not least, the stock exchanges, the NYSE and the NASDAQ.
Do you think that the stock exchanges are going to pick up because volume will increase, or do you think there's really been a shift in that whole business where people go trading online, people go to trade electronically, and a lot of people may be shying away from equities altogether?
Yes, yes, and yes. Basically, we think that a valuation gap exists, and that significant evaluation gap just simply won't stay there. Historically, these stocks have traded at 20, 30 times earnings. Now they're trading around 10 times earnings. And while they are definitely facing some challenges, we think that at 10 times earnings, the market is just simply underestimating the valuable franchises that exist in these companies.
And you think, we'll start from the bottom here, stock exchange stocks, you like NYSE and NASDAQ, the two obvious names. Why those two?
Whenever we buy an out-of-favor sector, we want to own the dominant best-of-breed companies. We don't want to go down into second and third-tier companies, even if they're cheaper. We want to buy the best of the best so that if the difficult conditions continue, that their best finance have the best management teams. And then when things turn, money typically comes into those biggest best-of-breed companies.
All right, hang on, Harry. We're going to come back and talk about a couple more stocks on the other side of this break with Harry.